Okay, welcome back. I'm going to do one question from the Lopez textbook that is exercise 13.12 that is share issue as well as option. So in this question, I'm introducing the option as well as the basic step to record the issuance of shares. The basic step to record the issuance of shares. So let us read this question. Okay. On 30th June 2021, the equity of Moray Limited consisted of 400,000 ordinary A ordinary shares, type A ordinary shares issued at $250 each, fully paid. So 400,000 multiplied by 250. So the value is over here is 1 million. The value is 1 million. Okay. Okay. This is the 1 million. Second, you have 75,000 6% cumulative preference share issued at $3. The issued price is $3. But now until okay 30 the date of 30th June 2021, they only pay $2. So there's another outstanding amount of $1. So 750, yeah, multiplied, sorry, not 750, 75,000 multiplied by $2. That is why you have your shares, preference share, 150,000. That is 75,000 multiplied by $2. Okay. What is the 6%? The 6% is the dividend. This is the dividend. Every year, you're going to pay, you're going to give your preference shares 6% dividend. That is high. The 6% is considered as high. Okay. Next, number three, we have options. Option is the right to buy, not obligation. You can buy, but if you don't want to buy, it's okay. Option, the value of this option is 65 cent each, 20,000 multiplied by 65 cent. So this is 13,000. And your retained profit, or this is your accumulated losses or retained earning accounts, retained earnings is 12,750. So you are given the equity. You have asset, liability, and equity. So you're given the equity part. As the company had a loss for the year ended 30th June 2021, no dividend were declared for that year. So no dividend. The option were exercisable. The option here refer to this option must be exercised were exercisable between 1st March 2022 until 30th April 2020. So you're giving them 62 months. 2 months to decide whether they want to exercise, where they want to use their right to buy shares. Each option allowed the holder to buy one A ordinary shares for 450 each. So if they want to exercise their option, they can. They need to pay 450 for the A shares. The A shares here, they need to pay 450 per shares. So you have to check at the stock market what are the current price of the shares at the market. So if it's much higher, then this is the best time to exercise your shares. Okay. But if the company is not listed company, so you have to decide about the prospect of the company, whether they can generate more income in the future. If yes, then this might be a good investment. So this is the situations. Okay. So you have several, you're given several transaction happens, yeah, several transaction happen here. So you need to record the journal entry. You are required to record the journal entry for the above transaction, and then that is number one. Don't look at the number two. You're going to record this one first. Okay. Number one. Okay. July 25th, the directors made the final call, mean asking for money now for the $1 of the preference shares. Now they make announcement, they sign a letter that they are calling for $1 payment for the preference shares. If you look at your preference share, which one is your preference shares? Okay, this is your preference shares. Issued at $3 but only paid by $2. So there's a difference of $1. So you are calling them to pay this $1 from this 75,000 unit. So mean you are calling for payment of 75,000 dollars, because $1 multiplied by 75,000 unit. Okay, this is what we call as call, yeah, call. So when you do this, what happen is your shares now from 150, you're going to increase, you're going to plus by 75,000. So what are the journal entries? What is the journal entry? What is the journal entry? You're going to credit your 6% preference shares. You're going to credit the 6% preference shares. Okay. $75,000. So how are you going to do it? I'm going to credit the 75,000. Let me show you the answer. So the first one, you're going to credit 75,000. Credit 75,000 preference shares. Okay. And then you're going to create a new account. We call it as call. It's like a receivable account. Call for preference shares. Call for preference shares. 75,000. So you expect to receive the money. So you have two accounts here. This is your preference shares. Before this, you have 150. Now you add another 75. So your balance of preference shares now will be 225. So this is the idea. Okay. Don't get the cash, but we create another account. We call it call. Call preference share. This is like receivable accounts. Yeah. 75,000. 75,000. 75,000. Okay, when they make the payment 75,000, for example, you're going to receive cash. This is another transaction. Cash 75,000, and then you close your call account. So your call account balance will be 0. Are you with me? Are you with me? Let me repeat again. What is the process then? Maybe in terms of account, it's much easier to show rather than showing the journal entry. Let me go slowly again. Okay, this is your preference shares, PS. I call it PS. Preference shares. Your balance BD is 150,000. So when you call for the next payment or the balance of 1,000, the payment is for $1 multiplied by 75,000 units. So you're calling for $75,000. So what I need to do now is I credit my preference share 75,000. Okay, do I receive the money? No, no. So I create another temporary. This is temporary account. Temporary account. I create call. It's like receivable account. Call preference shares. So I'm going to debit here 75,000. Okay, yeah, 75,000. If they make the payment later on, when you call them, they make payment. So you'll go to your cash account or bank account, 75,000, and then you're going to credit this 75,000. So your balance here will be zero. So we close this account. This is just temporary accounts. This is just temporary account. Are you okay with me? Can you follow me? Yeah, good. Okay. So the first journal entry will be debit call preference share 75,000 and credit share capital preference share 75,000. The next one, we did this one. Second one, August 31st August. All call money were received except those owing on 5,000 preference shares. So we have 75,000. We received 70. So 5,000 is unpaid. It is on August 31st. So how are you going to do that? Very easy. Still remember you have 75,000. From this 75,000, you receive cash plus 70,000. Why I put cash 70,000? And this one is unpaid. Unpaid. The balance is unpaid. Is 70,000. The balance 5,000 is unpaid. So how are we going to record the cash? Debit cash 70,000. It's very easy. Debit cash 70,000, and you're going to record credit your call preference shares. Call preference shares 70,000. So in terms of journal entry, I'm going to debit here my cash. I'm going to debit my cash 70,000. Receive the cash 70,000, and then the call here, I'm going to credit 70,000. So the balance for my call is 5,000. This is the outstanding 5,000. 5,000 is the balance. Why I'm going to do this with 5,000, we need to read the next statement. So the answer will be debit cash 70,000, credit call for preference shares 70,000. So my receivable now is only 5,000. Unpaid, yeah, unpaid. On 7 September, the directors resolved to forfeit, yeah, the preference shares for non-payment of the call. So we're going to cancel that one, the 5,000. The constitution of the company direct that forfeited amount are not to be refunded. You're not going to give them that their money. So you're going to keep the money to the shareholders. The shares will not be reissued. Will not be reissued. Okay, so what it means here is for this 5,000 is unpaid. Before this, they already paid 10,000. Are you okay with me? Because this is 5,000 multiplied by $1. They failed to pay this 5,000. Before this, they paid 5,000 times $2. So this is 10,000. We're going to forfeit this 10,000. We're going to forfeit this 10,000. Are you okay with me? Do you know how we get 10,000? Yeah, because in this question it states that they already paid $2 out of three. $2 out of three. So I'm collecting another 1,000. However, this 5,000 unpaid. Previously 10,000 paid. This is paid. This is unpaid. So I'm going to take that 10,000 from my accounts. So what will be the journal entry? I'm going to reduce my share preference debit by 15,000 to reduce my preference shares. I'm going to close my call account by 5,000 and I'm going to include the 10,000 in my forfeited reserve. Forfeited shares reserve. Forfeited shares reserve. If you still remember, I have here 225. If I total this, I have 225. However, we're going to take out the 15,000. So this 15,000, I'm going to take out this one, forfeited shares, forfeited preference shares, and my balance will be 210,000. So this is my balance CD, my balance CD. Yeah, it will be 225,000. Okay, and this 5,000 I'm going to use to close my call account. So my call account, this one, forfeited preferred shares. This one will be zero. So zero balance for that. And I'll create another account, a reserve account. This is another reserve account. The balance is 10,000. The balance is 10,000. So this is forfeited preference share reserve. Reserve. Are you okay with this? So what will be my cash balance? My cash balance will be 70,000. Call will be zero. This will be closed. My preference share is not 225, it's only 210. And I have this reserve 10,000 from the forfeited account. So that is why we debit the share preference, share capital, the preference shares in order to reduce it by 15,000. Okay, because we originally plus 10 plus 5, and then we're going to close our all preference shares account, and also we're going to create forfeited preference share reserve account 10,000. So that is the process when we deal with ordinary shareholders. Are you okay with this? Aina, Kamila, Mehrab, Akul, Inakshi. Yeah. Okay. So that is about options. Now we move to the next questions. The next options. The next question is November 1st, the company issued a prospectus offering a new share, 40,000 B ordinary share payable in two installments. Okay. $3 on application. When they submit the application, they pay $3 and $2 on 30th November. The offer closed on 30th November. So you have to make two payments. We're going to offer them to invite investors to buy these 40,000 B ordinary shares in two installments, $3 when they submit the application and the remaining $2 when we make the a call, yeah, most probably on 30th November. So on this date, November 1st, no journal entry. No journal entry. We don't receive any money, we don't receive any application. So no journal entry on November 1st. Are you okay with that? No journal entry on November 1st. Okay. Okay. Then on 30th November, we receive application oversubscription now, 50,000 B ordinary shares. 50,000. We advertise, call for 40,000. We receive oversubscription of 50,000. So can you multiply this by $3 each? $3 each. So we receive cash of 150,000. So this is the cash. The cash is not ours yet because we haven't decided who will get the shares. So we put into a temporary cash account. We call it as cash trust. Cash trust, yeah? Cash trust. Call it as cash trust. So this is temporary account. Cash trust. So what will be the journal entry? You're going to put that money not into cash, but cash trust debit 150, and they're going to record it as the application. Application is the first step when they submit. It's not shares yet. It's not shares yet because we haven't decided who will get the shares. So I'm going to use application accounts. Cash trust account and application accounts, credit application accounts by 150,000. So this is temporary accounts, temporary. So the process is when we issue prospectus, no journal entry, and when they make application, we're going to record into account. We call it as application account. So this is the number one, application. This is temporary accounts. Debit, cash trust, this is also temporary accounts. This is also temporary accounts. It will go to cash account later on, yeah? Temporary accounts. Okay. Okay. On the following day, the directors resolved to allot the the B ordinary shares pro rata with all applicants receiving the 80,000 the share applied for. Excess application money were allowed to be held. The share were duly allotted. What does it mean? It means that though we receive more than what we expect, the 50,000, we're going to give everybody, every applications, a chance, yeah, a right for the shares. So we're going to give them, if you apply for 50, you get 40. If you apply for 10, you get 8. So that is the pro rata. Pro rata. Everybody will get shares. If we don't do that, if we do first come, first serve basis, there will be 10,000 application have to be rejected. And then we have to return the money from the cash trust to the applicants. Are you with me? Are you with me? We're going to reduce our applications and then we have to return the money back to the applicants. In this example, we're going to use pro rata basis and our company policy allow us to keep the money, the extra money. If you want to buy 10, you only get 8. So the difference that you already paid, the 2 here, will be used for the next, for the next call, next payment. Because if we receive application for 50,000, but from this 40,000, we're going to only issue 40,000 shares. 40,000 shares. So the balance 10,000, we're not going to return the payment, but we're going to use this payment for future payment. So that is what we call as for the we're going to keep the excess. We're going to keep the excess. So how are we going to do that? So our applications, we're going to debit our application. We have applications. Previously, we record applications, 150,000. This is temporary accounts, the application. Let me just put this as application. 50,000. we have a cash trust, also temporary accounts 150,000. Okay, from the 150, this 150 come from 50 multiplied by 3. That's why 150. But when come to the real process, we are not going to issue 150. We're going to only issue 40,000 multiplied by 3. That is 120. So I'm going to create the new accounts. Create share capital for B or B type share capital. I'm going to credit this by 120,000. Okay, this is the application. So I'm creating the new accounts here. So I will close my application accounts by 120,000. So this is the first journal entry. I'm creating the share capital accounts 120. How does this 120 come from? 40 multiplied by $3. 40 multiplied by $3. That is 120. Okay. And then going to close my application accounts 120. Still have 30,000. That 30,000 will be used for future payment. Call receive in advance. Yeah, call in advance. So this is the share capital. So I create another account, call in advance. We don't receive that yet. We don't call it for that part that, but we already received the money. So I'm going to put 30,000 here, call in advance. Later on, we're going to transfer to the share capitals, and then I'm going to close here 30,000. So automatically, my application account now close. Can you see this? I transfer this 150 to the share capital and to the call in advance. Call in advance. Okay. So how to record that journal entry is going to be application, debit 30,000, call in advance, credit 30,000. Okay, what happened to the cash? The cash trust now, we're going to close the cash trust accounts, transfer it to the real cash account. So this is my cash accounts. I'm going to transfer this 150 now. So I'm going to close my accounts here. So I'm going to credit 150. So this is also close. Also close. And 50,000. So now my cash increase. Why I put 150? Because this 150 is all ours now. It's all ours. We have informed them that we're going to issue 40,000 new shares. The 40,000 times 3 is 120. And we also have call in advance, money received in advance for future call 30,000. Money received in advance for future call 30,000. So indirectly, if I delete this part, just delete for temporarily for you, you will know that you already received 150,000 for the ordinary share capital 120 and the call in advance 30,000. The call in advance 30,000. So you have to do it step by step. We have cash trust, and we also have application. For cash trust, we have 150 and then we close 150. For application, we receive for 150, 120 go to the share capital, and other 30 go to the call in advance. So the balance here is 0. The balance there is 0. Are you okay? We're going to do this for your quiz one later on, yeah? For your quiz one. So that is the journal entry. Okay. Any questions? No? Okay. The next one is the process. The underwriter charged us 8,600. This is the share issue cost. There are two ways of doing these transactions. in Malaysia, it's common to come up with this, record this as an expand. So debit, share issue expand, credit, cash. Yeah, but in Australia, it's more common to offset this share issue cost to the share capital accounts. So what will be the answer? You're going to debit the share capital accounts. Share capital for B ordinary, the 8,600 will be deducted from the share capital accounts 8,600, and the payment credit cash 8,600. So this is another technique of doing it. Yeah, but I personally would prefer it goes to the share to the expand accounts. Yeah. Okay. The next one. Okay. April 30th, the holder of 16,000 option applied to purchase shares. All money was sent with the applications. All remaining option lapsed. The shares were duly issued. What does it mean? We have these options 20,000. Okay, this is our options. This is our options. The amount is 20,000 multiplied by 65, 13,000. This is 13,000. Okay. From this 20,000, 16,000 exercise their right. So they opt to buy the new shares. So there will be increase in the new shares. 16,000. 16,000. Okay. So what is the price of the new shares? The new shares price is 450. So the cash, I'm going to debit the cash. Cash increased by 72,000, and the share capital A increased by 72,000 as well. So 16,000 multiplied by 450, you get 72,000. So debit cash, increase in cash, and also increase in share capital, increase in cash, and also increase in share capital. So you must remember that you have here before this 13,000. 13,000. How are we going to do with the 13,000 option accounts? You're going to close your option account. So this is your option account. Option account, you have 13,000. So we need to close this one. Okay. Price I think is 65 cent each. You have 220,000 multiplied by 0.65. So that's why you get 13,000. From this 20,000, 16,000 exercise and 4,000, okay, leave it lapse. This one is lapse. Okay. So the 16,000, let us do for the 16,000 first. You're going to debit 16,000. Okay, you're going to do that one first. For the options, I'm going to record this one as 13,000. I'm going to close this one 13,000. I put here share capital 10,400, and then another one is option reserve lapse, option reserve 2,600. Yeah, so this is share capital, this is option reserve. So you're going to have your share capital, the share capital A. Previously you have balance. Let me check the balance. The balance is 100,000. The balance is 100,000. The balance is 100,000. Now you plus 72,000. And then you are going to plus with another 16, not 16,000. How much is the value of that? 10,400. You're going to credit by 10,410.4K. That is for share capital A. Then you have another option reserve. This is the, I don't say the profit, but since you receive the money, but you don't give them the share, it'll be your reserve then. There'll be kind of profit, not profit, a reserve, yeah. The amount is 2,600, 2.6K. So this is how we close our option account. So your option account will be closed. Yeah, close. You transfer the 10,000 to the share capital and the lapse amount to option reserve. Later on, you can transfer to general reserve. You can transfer to other reserve. Yeah. For the first year, just keep it as option reserve. So that is how you're going to do the process of issuing shares, options, or to this question. This is a basic one. We have more advanced questions. Okay. The next, do you have any questions? Any questions so far? No. We have something before, like this for your quiz. Is it okay? Is it okay for every one of you? Miss Yusra will discuss more advanced. I'll give you the foundations. So I want you to come to the tutorial. This will be online and do more questions. It's not so complicated, but you need to understand the process. Start with application, close the application accounts. Application is temporary account. Understand that. Close the application accounts. Okay. And then we have cash trust. We close our cash trust accounts. Okay. Then we transfer the money to the cash accounts. For application, we transfer that money, that figure to the share capital to the call accounts. Call number one, for example. Okay. And then we do the call, we increase the share capital, yeah, we increase our cash account. So that is the process. That is the process. Okay. The next one, next part will be if More Limited buy back 25,000 preference share for $3.50, what factor would it accountant have to consider in determining how best to record the transaction in the accounts? If you do the share buyback, share buyback, you buy back the share, so your cash will reduce, your cash will reduce, your preference share will also reduce. Yeah, that is share buyback. The preference share will reduce, your cash amount will also reduce. So the accountant should consider whether there are tax or dividend distributed issue associated with the particular equity accounts before determining which account to be affected by the buyback. If there are no such issue, the buyback can be written off against any equity account or across all the equity accounts. So because this is issue about tax, issue about tax. Okay, because sometimes when you issue dividend, you will need to pay certain amount of tax to the government. For example, if you pay dividend 30,000, so part of the dividend will be paid to the tax authority. So that is for exercise 213.12. 13.12. Okay. 13.12. Are you okay?